Welcome to Financial Strategies with Andrew and Daniel Agemy, powered by the Retirement Income Store and brought to you by Agemy Financial Strategies in Guilford, Connecticut and Denver, Colorado.
Oh, AAA, it is a sad, sad day. You know, the the Denver Broncos, they can't do anything. We've had this great defense, and we finally go get a quarterback who's supposed to be a great quarterback, a head coach that's supposed to be a great offensive coach. And when you're playing football, you want a high scoring game, right? You want to see people throwing passes way down the field. You want to see it go, 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 go. And the Broncos just keep losing and losing and losing. And not only are they losing, they're losing in embarrassing fashion. They're not scoring any points. And Russell Wilson just looks like a shell of himself.
Okay.
And a really interesting thing happened at the press conference on their last Monday night game. And they're actually interviewing Justin Simmons. And he said, there's a problem here, obviously. And everybody knows what the definition of insanity is. Doing the same thing over and over and trying to get the same results.
Or different results.
Different results.
From the same things. Yep.
I'm Daniel Agemy.
And I'm Andrew Agemy. You listen to Financial Strategies with Andrew and Daniel Agemy. Today's topic is, should I do a Roth conversion while the market is down? And we've been getting a lot of requests and a lot of questions along these lines about doing this. And so, Daniel, I think that you're talking about there's just insanity going on out there, right? That people doing the same thing over and over, expecting different results.
Yeah, we keep seeing that, right? We've had so many people come in recently who show us their portfolios. They're down 30-something%. They're down 25%. And they say, I told my person I wanted to be, conservative or moderate. How am I down this much? And that's insanity, right? They're just the same thing over and over. So we're going to talk today about benefits of being down.
Right.
30%.
Right. Most people are down, right? And, it's a gloomy day for a lot of people. And, the egregious thing is, when we're talking about being down, overall, right, that this is the fifth time in the past 15-ish year, 20 years, 22 years, that the market has taken a dive. And people are down again. Some people, for the fifth time in the past 22 years, their money is down. And the egregious thing is they have not yet hit the panic button because of why. That's a big deal, right?
Because of insanity, right? Because of insanity. It's if you're managing your money, it's you not knowing there's other options, maybe. If it's an advisor managing your money, maybe they haven't learned about market history. Maybe it's just insanity.
People are doing the same things the same ways. And one of the reasons why they're doing it
that way,
expecting
a different result, right?
Right.
Like now I'm 70 years old. Now I'm 23 years older from when, the time frame, the 5 crashes that you talked about. And I'm going to go through it again. So if it takes 10 years for my money to come back, if it takes 5 years for my money to come, I'm just not going to take a distribution for 5 years. Like that worked when you were saving money. It was actually helped you.
Right. And people are not getting it, right? The first time the market dropped in 2000, it was 7 years. The market dropped 50%. It took 7 years for the market to come back to where it was, just to get back to where it was. And then in 2007, when the market dropped, it dropped 60%, and it took 5 years for the market to get back to where it was. And then the market dropped in December of 2018. It just took a month. It dropped 25%. Took a month. It got back to where it was, basically. Then the market dropped in March of 2020, dropped 40%. It took just a few months to get back. Well, here we are, 2022. Since the beginning of the year, we've been 10, 11 months, well, about 10 to 11 months with a down market, and it's down. The market, the S&P 500 is down in the vicinity of 25%, and it doesn't show any signs of stopping. And people are still doing the same things the same way. And one of the reasons for that is because people got enamored with the 80s and 90s, where the market just kept going up, kept going up, kept going up, and they're listening to Wall Street saying, "Oh, the market always goes up over time," and so they think it's going back. But if you're in or close to retirement, it's a different deal now. It's a different situation, and that's where the insanity part comes in, right?
Yeah, yeah, it really is, and it's heart wrenching. It's just, I mean, you've gone through this of like you've seen people's responses for many
Right.
times, right?
That's right. That's
And
right.
to me, I'm like, how did someone let this happen to themselves? How would you like? You're in this aggressive stuff, but people don't know, right? That's what the show's
Right.
about. People don't know what they don't know. Uh, they trusted their advisor. They trusted whatever that you're in something that you can either benefit from or it's going to be okay or these kinds of things. Um, but markets go up over time is not okay. That's not an investment strategy. That's not a successful stress-free retirement.
Right.
That that's a stupid mantra. That's a stupid line, right?
That's rhetoric from Wall Street. Yep. That's
I don't know.
right.
It started to piss me off a little bit that people are being taken advantage this way, but yeah.
Well, I can understand that and see that, and I agree with you. But if you've just joined us, you listen to Financial Strategies with Andrew and Daniel Agemy. And today's topic is, should I do a Roth conversion while the market is down? And we're addressing that. One of the things as we're going to get into today is talking about how that's going to be a tax strategy as well as an investment strategy to do a Roth conversion while the market is down. And we have a paper we'd like to give you in preparation for that will help you understand other tax strategies. It's called Proactive Tax Saving Strategies. We'd love to put this in your hand. Just call us at 800 725 7616. 800 725 7616. It's a paper, about 3-page paper, that will give you some ideas of how you can do some tax harvesting, as they say, and do some tax saving. This is a great time of year. We're doing this in October, and great time of year to start doing tax planning for 2022. Because once January 1st comes, it's too late to do tax planning. Is now in damage control. So get this so you can do some tax planning. Proactive tax saving strategies. Call us now, 800-725-7616. You listen to Financial Strategies because people don't know what people don't know. Today's topic is, should I do a Roth conversion while the market is down? Well, Daniel, the market's down, as we said, 25%, the S&P. The NASDAQ is down further than that. And we've seen people's accounts with big name firms that are down 30+%, worse than the S&P. And they're saying, well, what do I do? What's going on with this? And some of them, are wondering, well, is this a good time to do a Roth conversion while it's down? There's two different angles we can take this from, right? One is the angle of tax savings, and the other is the angle of investment growth from that standpoint. So, what do you think we should take first?
Well, just like these Denver Broncos, and we should probably timestamp this. Today is October 19th. And when we're talking about how much the market's down, we're talking about how the Denver Broncos just keep losing and losing and losing and looking terrible. Hopefully, they're going to make changes, right? And not
Right.
keep up the insanity. They're going to make some changes. And by the time this show airs, or, if you're listening to it later, because you can listen to these shows whenever you want, it's just going on our website.
Watch them, listen to them, whatever you want. That's right. YouTube.
There's some really good ones out there, especially we've been doing a series lately about alternatives to the stock market, things that you can invest in that preserve your wealth and generate you either promised or guaranteed income. But hopefully the Broncos make a change, and we want to show people, help people understand some changes that they can make, and maybe they can take advantage of these mistakes that have
Right.
been, take advantage of this terrible situation where you're down 25%, where you're down.
Right.
I mean, even if you're down 20%, that's crazy. And like you said, we've had quite a few people come in who want a second opinion because they're down 30%.
Right. 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 And, the thing that I want to bring out at this point is the aspect of what it, I'm going to, Siegel's paradox, Jeremy Siegel of Wharton School of Business, brought this out as far as if the market drops, if you lose 50%, you have to gain 100% just to break even. So if the market, in 2000, the market dropped 50%. It took 7 years for it just to get back to even. It went up 100% from the bottom in March of 2003 to when it went back up in 2006 by the time it equaled 2000. And then in 2007, when it came down 60%. In order to market to get back just to where it was when it comes down 60%, it's got to go up like 120, 130%. That's huge, right? So, when I said 2018, the market went down 25%, came back within a month. Well, it went up like, 30% within that month. And the same thing with it to 2020. Right now, the market's down 25%. You're going to have to come up 30 to 35% just to break even. Do you see that happening in the stock market anytime soon? I don't see that. I think it's going to get worse before it gets better. And
and it's those paradigms, because that's not acceptable, right? That's
right,
not acceptable. Now, if you were,
especially for a retiree, especially a retiree,
exactly for the retiree. If you were 27 years old, you were 37
right.
years old,
Big deal.
then that 100%, that 150% come back to even helped you because you were saving. The difficulty is if you had $1 million
Yep.
in 2007,
Yeah.
right?
Right.
It was until 2013
Right.
that you even got back to $1 million. That's without any fees,
Yep.
and that's without you taking out any money.
Right.
You didn't come out ahead, and that's why I say it's not acceptable. We're talking about some other different options, and wrapping that in with a Roth, how that can benefit you even more.
Right. And that's a very good point. You brought up that's without any fees coming back, right? And a lot of people have 1% to 2% fees, whether they know it or they don't know it, on their stuff, which over that period of time digs into it even, over that 5-year period, that's another 10% down from that angle. So, people don't get this stuff. But anyway, that's why we're talking about, at its insanity. And we have a book, Financials Insanity, right? How to Keep Wall Street's Cancer from Spreading to Your Portfolio. This is a great book, very easy read. You can read this whole thing through in like 2 to 3 hours by our friend David Scranton. And we'd love to put this in your hand because you got to do things differently when you hit retirement than you did before you were in retirement. When you start getting 50, 60, 70, 80 years old, things need to be different, especially when you have to start taking that required minimum distribution or you need the money to live on. So we'd love to educate you on how to do this. This is available for free to the next 5 callers at 800 725 7616. 800 725 7616. We'd love to put this in your hands for free, no obligation. And you're listening to Financial Strategies, then you're Daniel Agemy. Today's topic: should I do a Roth conversion while the market is down? Call now.
I'm David Scranton, founder of the Retirement Income Store. If you're in or near retirement, are you certain you have the right retirement plan in place? Do you want to help ensure your nest egg will last you all throughout retirement? Take our retirement review quiz and find out in 5 minutes or less if you're doing everything you can to achieve a more successful retirement.
Visit us online at agemy.com. That's AGEMY.com. Welcome back to Financial Strategies with Andrew Agemy in Connecticut and Daniel Agemy in Colorado.
AAA, we can't talk about Roth conversions without me thinking about one of my favorite examples of it. We had a client come in, talking to a client about doing a Roth, and he's an aggressive guy. he really loved American funds, the whole universe of mutual funds and things like that. We're trying to explain how the income model worked. And at about $100,000 worth of bonds, but it was trading at around 60. Now this was around 2015, 2016 when the White House had made a declaration that energy companies, right, were bad. And so all these energy companies came way down in value. So you were able to buy their corporate bonds that were paying, double digit returns. So it was like buying a dollar for 60 cents or 65 cents. And so we had these things, and we converted it from his IRA to his Roth. And it was something like taking $100,000 out of an IRA, paying tax on $60,000 or $65,000, putting it into the Roth IRA. And then, of course, those things came back to par over time, collected the dividends. You can, with a bond like that, they can either buy it back from you early, or it can go to maturity where they buy it back from you, right? So that's one of the neatest things about doing these conversions, is when you know what you're going to get in the end. I'm Daniel Agemy.
And I'm Andrew Agemy. And today's topic on financial strategies with Andrew and Daniel Agemy is, should I do a Roth conversion while the market's down? This father and son team would like to bring to you information that you may not know, and we would like to educate you so that you can make smart decisions. So that's a lovely example, Daniel. So how I got that is, we converted in that example $60,000 from his IRA into his Roth IRA, paid the tax on $60,000, but then because of what we bought, we knew, because it's either guaranteed or promised, that it was going to be worth $100,000 at a few years into the future, and that's what happened. So he got a bump up and a huge discount on his taxes, and made some serious money on that deal. Made $40,000 on that deal, right?
Tax free.
Tax free, right? And
that's why we're talking about this now. These things don't work for everybody, right? And there's some pros and there's some
don't
cons.
try this at home. Don't try this at home.
There's some pros and some cons to doing the Roth conversions. There's stuff you need to know about, like it could hurt you, depending what brackets you're in, right? I think about a story somebody told us the other day where somebody made an extra $40,000, and because it made one of the credits they get go away, it made their $40,000 growth. It made the rest of their money taxable, and so they had to pay $40,000 in taxes, and so they didn't end up making anything on that growth that they got. Right. And you don't want to do that, because that's not going to help you. That's not going to help you take advantage of these situations. It's a sad day that people are down that much, but what can you do to take advantage of it?
That's what we're talking about. Well, the whole idea behind a Roth IRA is that you pay tax you put money in that has been taxed, and then you never pay tax again when you take the money out, because all the growth is totally tax-free, not just tax-deferred, tax-free. So if you convert money from an IRA, you take money out of an IRA, you pay the tax on it, and then you put it in your Roth IRA, and then all the money that it makes will be totally tax-free. So that's an important thing to be able to understand how Roth IRAs work. And so if you're able to, the market has come down, and if you have $100,000, that's come down to $75,000, and you want to take all of it or part of it to convert to a Roth IRA. And when you convert it, you put it into things that are going to come back to 100,000 or even beyond 100,000. That's a sweet deal, because you're paying tax on the 75. It's $100,000 worth of investments that you're paying tax on 75,000, and then eventually it comes back. Then it comes back to the 100,000 or beyond, and it's tax-free money. Which, if it's tax-free, is for me. I love that idea. So, you're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is, should I do a Roth conversion while the market is down, while the stock market is down? We have the market's dropped 25%, depending which market. The S&P is down 25% or so. We have a paper that we'd like to give you to be able to help you do tax planning as we end up and closing out in the fourth quarter of 2022. Proactive tax saving strategies, which will help you be able to be prepared and take advantage of paying lesser taxes while you can. We'd love to put this paper in your hand. It's only about 3 pages, and you can have it by calling 800-725-7616. 800-725-7616. You're listening to Financial Strategies with Andrew Daniel Agemy, because people don't know what people don't know. So, Daniel, what else is it? So people can do these Roth conversions, get advantage of tax strategies. Good time to do it because the market is down, but also taxes are at a lower rate right now than what they're scheduled to be in 2026, 2025, somewhere in that vicinity. So what else?
So let's talk about a couple of those the cons, so people know what they're getting into. So people can watch out for Roth conversions, because all Roth conversions are not created equal, like we talked about.
That's right.
And you're not going to be happy if you do a Roth conversion. You're really not going to be happy if you do a Roth conversion on a super speculative asset, and then it goes to zero. And then you paid taxes on something, got it into your Roth, and it went to zero. So now you got a double whammy. So you have to be careful what you're converting. Right. So when we talk about
that's key.
When we talk about some of these people we've seen come in with these portfolios that they were told, hey, this thing's pretty moderate, or I asked you to put it in moderate, and now look at what this thing looks like. It's down 30%. Some of the stuff that we're seeing in these portfolios are insanely speculative. And you can have a good company.
Yeah.
Right? You can have a good company. That doesn't mean it will ever get back to the price that it was if it was trading at too high of a valuation. So not even going to zero, right? So Cisco is a perfect example of that, right? Mm-hmm. It still has not reached its high
from where it was in 2000.
Yeah.
Right.
Yeah. And so, that pays a dividend at least. So if you're reinvesting, you might be higher. But we don't like might be's or maybes or hopes. So you just have to be careful what you're converting. And that's a good company. So some of these companies that we see in these portfolios aren't even good companies.
Right.
Yeah. They don't make any money. They're not profitable. It's crazy. So you have to be careful what you're converting, because you wouldn't want to pay tax and then go to zero and not have anything left. That doesn't make a lot of sense. Let's talk about some of the tax consequences, some of the things that can affect people negatively that they might not think about if they're just looking at tax brackets. I'm in this tax bracket. I have this much room. I've got $20,000 room before I go into the next bracket. And maybe you can explain how the tax brackets work, because a lot of people don't understand that it's a tiered system.
Yeah. Yeah, glad to. So, if you're married filing jointly, let's just say, or whatever, we'll just talk about the 10% bracket. The 10% bracket represents this. You're paying tax, 10% tax on this amount of money. But then if you make this much money, you're in the 12% bracket. Look at it. I'm doing this on video, so the people on the radio can't see what I'm doing, right? So let's use some numbers so the people on the radio can actually understand, or who are just listening to this while watching, right? Okay, so let's do the married filing jointly bracket, right? That $20,000, up to $20,000 of taxable income is taxed at the 10% rate. So let's say you have $150,000 of taxable income. Well, the first 20,000 of that 150, you're paying 10% on. Then the next $63,000, you're paying 12% on. And then the rest after that, up to the 150 of taxable, you're paying 22% on. And then if you get pushed into the 24% bracket, you're paying 24% tax on whatever is in that bracket, wherein right now the highest bracket is 37%. So, if you're in the 22% bracket, you're not paying 22% on all your money. It's just in the money, in the example of the taxable money in a married filing jointly over $83,000 that in a year that you're paying tax on. So that's how the brackets work. And so when Daniel's talking about bumping the bracket, as we call it, if you're in the 22% bracket, married filing jointly, you can have $178,000 of taxable income. And there's a difference between gross income and taxable income. And there's too much to go in regard to say that today, but please understand there's definitions. That's what we're always talking about. Definitions are important. You have to understand what is taxable income, what is gross income, what do those mean? But if you hit the 178, if you went above the $178,000 level, then you'd be in the 24% bracket. So you'd want to stay in that bracket if you could, or lower bracket, that kind of thing. So we come up to that bracket, but then stop. But the thing that goes along with that is, if you're 65 years old, or actually if you're 63 years old, the money that you're making when you're 63 years old is going to affect what your Medicare premiums are going to be when you're 65 years old. So you have to be careful, because then there's brackets for that. And if you go above the bracket for that, it will throw you into high premiums for your Medicare, which it's not a tax, but it kind of is, because it's based upon how much money you make that the premium is going to go up, and you're going to pay more on it from that angle. So, tax, that's why we say don't try this at home, because there's intricacies with this that are important to make sure that don't happen. And like Daniel was, actually, we came across somebody recently that did a Roth conversion with their other advisor, and it threw them into another bracket for their health insurance. They weren't 65 years old, but for their health insurance, which did kind of the same thing, and they had to pay, I think it was thousands of dollars extra in taxes because, or excuse me, in premiums for the health insurance, which again, like a tax, because they went above the bracket that they should have been in to keep it in good state. So it's insanity. It's insanity. People are doing things, doing the same things, same way, but expecting different results. And that's why it's important to be able to have the knowledge that you need. And we'd like to give you this book before we take this break, that's going to help you have knowledge to keep from creating a financial insanity in your life, in your portfolio. This is how to keep Wall Street's cancer from spreading to your portfolio. That book written by David Scranton's first book, written in 2011, but it still has very pertinent, good information for you that we'd love to put in your hand. Easy read. Call us at 800-725-7616. The next 5 callers at 800-725-7616. Call now.
History tells us the market goes up and the market goes down. What would you do if you lost half of your retirement savings? It's time to make the shift to steady, reliable retirement income. And where do you go? The Retirement Income Store. Log on to agemy.com for your free retirement review. That's AGEMY.com. The Retirement Income Store, where retirees go for income.
Welcome back to Financial Strategies with Andrew Agemy in Connecticut and Daniel Agemy in Colorado.
Hey, Daniel, one of the things I really enjoy is when I'm sitting with my clients and doing these reviews with them. And 2 things they want to know when they come in is, how's my money in regard to the stock market? How is my money in regard to inflation? And, the inflation aspect is keeping up with spending power, right? And it's the money they actually spend which is more important than their portfolio amount. But, Henry came in and I was going through his accounts and looking at this stuff. And I said, well, Henry, in regard to the market, you're down maybe, the market's down 25%, and maybe you're down 5% right now. But the good news is that your retirement income, that which you can spend in retirement, went from $50,000 to $60,000 in the past year. And people always want to know how did that happen, Andrew? Well, that's because of number one, we invested your money into dividend income paying investments, as well as doing a Roth conversion. So not only was that 20% increase from your purchasing power went up 20% from 50,000 to 60,000, but also about 12%, about 7,000 of that was tax-free income to you, is tax-free income to you, which, if it's tax-free, it's for me. I'm Andrew Agemy.
I'm Daniel Agemy, and you're listening to Financial Strategies. Today we're talking about, should I do a Roth conversion while the market's down? And there is some very good reasons to do Roth conversions. There's some pitfalls you got to watch out for when you do these things. And AAA, that's a good story. It's a good illustration of, if you have $100,000 of income, it sounds like a lot of money, but then after, the government gets their hands in your pocket and this and that, it turns out that it's not so much money to you. Maybe you get 80,000, maybe you get, $70,000, depending on your other income and stuff like that. When you have $100,000 of Roth income, that means you got $100,000 you get to use. It's That's amazing. Right. And it doesn't hurt you. It doesn't hurt you in other things, right? Like it won't affect your Social Security,
right?
And it won't affect
your Medicare.
So it's actually almost like it's more than $100,000,
right?
Because It's not negatively affecting you on some of these other things that you would be negatively affected on if you were just taking $100,000 of income from taxable accounts.
That's right, Daniel. And that's what's so cool about it is it's like, maybe a 20 or 30% increase in purchasing power because you're not paying taxes on it. That's one of the ways we help people stay up with inflation is, in my example that I started, he was up 20% from last year, but even more than that, because part of that became tax-free that wasn't tax-free before because we did a Roth conversion. So he was really thrilled with that example. And so are we, because our goal is to make sure that people don't run out of money, right? The greatest fear that retirees have is running out of money. And we work really hard at keeping that not in the forefront, being able to help them be able to be stress-free in regard to that. But, when we're talking about this stuff, Daniel, we're talking about, is it now a good time to do stuff in the to do a Roth conversion? And it is a good time because the market's down. So things are down, but you're paying tax on $100,000 or $50,000 worth of taxable income at a lower rate because it's down. That's a good thing. But the big question is, what do you go into? And that's why we say, don't try this at home, folks, because you have to know what you're doing. Now, there's not, but they're far and few in between when it comes to this kind of stuff, because most people know about the stock market, not the fixed income market, which is what we're talking about, where you have promises and guarantees. Now, things are down substantially, and they may even go lower. So the big deal is, don't procrastinate. Don't wait till you get around to it to change your strategy to do these things, because if you start now, it takes time to actually make things happen. And this is a good time to do Roth conversions prior to the end of the year. If you wait until December, you're probably thinking you're probably too late, only because there'd be a lot of people making a mad rush. And last year we were doing them, and it was up until the 31st of December that things were being done. And we are not getting into that this year like we did last year. But the point being here is that um, now's the time to be looking at doing that and taking advantage of that. By the time you get your things converted and look at buying what's available, the market may have gone down further, and you can take greater advantage of it if you do it right and if you have the right people helping you, right timing from that angle.
Yeah. And yeah, when you're talking about there's two types of investing, right? There is income investing, which is what we call investing because it's paying you.
Right.
It's assets that are paying you. And there's stock market based companies, and these are companies that make a lot of money, right? They make a
Yeah.
lot of money and they pay it out to you in the form of a dividend. And these go up and down during the market. They work like the market. Um, but what they allow you to do is they allow you to generate an income that you get to choose what you want to do with it.
Right.
And then
Right.
there are fixed income, or there's um, things that have a contract associated with it, where you lend a company your money, or you lend a government, or you lend a municipality your money, and they promise to give you a certain amount of income and give you your principal back at a point in time. And those are two ways that you can support the lifestyle that you want to have. One's a little bit more robust than the other, but this is two different ways, right?
Right.
Of generating the income you need so you either can benefit from market downturns or you can at least keep the same lifestyle that you had before the market downturn.
Right, right. People, you're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is, should I do a Roth conversion while the market is down? And we have a paper that we'd love to put in your hands called Investing for Income in the Stock Market, which was exactly what Daniel was just describing. This is, I don't know, 3-4 page paper that will give you an idea of how you can get income from stock market based investments. So, what this allows people to do is just do a lateral move from the market into the stock market into better paying that can increase the amount of money that you get in dividends. You can still get growth out of it, but it can lower your risk because the dividends will lower your risk. So we see many big name companies that don't give people customized portfolios that by going into a portfolio like this, or from a 401k in a portfolio like this, you're going to lower your risk and increase your return. So check out this paper. It's called Investing for Income in the Stock Market. Get it for free by calling us at 800-725-7616. You're listening to Financial Strategies, Daniel Agemy, because people don't know what people don't know. Daniel, this is a great way for those people that just are enamored by the stock market, have lost money, and they want to get their money back. Maybe they don't need income, or they don't need a lot of income for their lifestyle. That this would work well if you're going to be enamored with the market and want to hope for the best and plan for the best. This will still give you help do a little bit of planning for the worst at the same time. Great idea.
Yeah. So you're down, you switch, you do your Roth conversion, then you can switch the models because when we talk about, if you looked at the market in 2000, that you looked at it in 2013,
Yeah.
right? It's flat.
Right.
It wasn't flat because you dropped 50% and you dropped 60%, but you didn't
Right.
make anything in that
Right.
period of time. You don't want to do that again. Now, we're not saying that it's going to be 13 years before anything comes back, but you have to plan for the worst and hope for the best, not hope for the best and plan for the best, right?
Right. Right.
So you want to plan for the worst, and if you do this type of thing where you take your loss, your 30% loss, your 20% loss, wherever you are, you convert that over, and it works in folks, listening situation. It works for them. It's not going to put them into another weird tax bracket. It's not going to hurt them
Right.
tax wise, or for Social Security, or for Medicaid, or any of these things, right?
Right.
Then you move that over and you have the ability to switch into one of these models where it's either investing for income in the stock market or investing for income from one of these, entities that you loan them their money and they pay you back, because then you're going to get the amount of growth from buying something under par, right? Undervalued,
Yeah.
paying 80 cents for a dollar. You're
Right.
going to get that 20% increase.
Yeah.
And you're going to collect whatever the coupon is. So that's 4%, if that's 5% coupon on top of that. So you're getting paid for them to either buy it back for you or markets to turn around and that to come up to par or above par. So when we talked about the example earlier, the gentleman that decided he was going to take $100,000 in par of bonds and bond-like instruments and move that over to the Roth and pay tax on $60,000 or $65,000.
Right.
He knows that account is going to come back up to
Right.
the 100,000, but that's not all, because you're collecting the dividends inside of there. So some might have a coupon of 6%. It was back then, so there was a lot of high coupons because these were oil companies that needed to pay money, energy companies that needed to pay a lot of money for debt financing because rates weren't always zero, right? Rates weren't always so low. So you're collecting 4%, 6%, maybe 8% on some of those.
Right.
Plus, it's coming back up to par. So that's a way where you're feeling bad because, there was mistakes made.
Right.
Your portfolio is down. Your advisor didn't know what they were doing. Whatever the thing is, the unforeseen happened.
Somebody was asleep.
Portfolio's down. There still is options where you can take advantage of that and convert it, but then be able to switch to an income model where you're a little bit more robust and a little bit more certain on getting the returns.
Exactly. When more certain on when you can get your money back. That's key, right? Like you said earlier, some of these companies that they're investing in, they won't come back. But in these things, we know about it. And it's a great thing. I mean, who wouldn't want to get, to buy $100,000 of investments for $80,000? I mean, the person that doesn't know what they're talking about, right? Again, insanity, right? So we like to do that for people, is get them a 20% discount. This is a great time to be doing that. And we like to give you a book. We're going to have to take another break. This time is going really fast. Hope you're enjoying today's show. You listen to Financial Strategies, Andrew and Daniel Agemy, because should I do a Roth conversion while the market is down? We like to educate you so you can make smart decisions. We got a book we like to give away to the next 5 callers at 800-725-7616. Financial Insanity. It's an easy read book. If you're a slow reader, you can probably read it through in 3 hours. It's that easy. And it's not financial ease. And you can get some ideas of how you can act defensively in this time so that you don't lose more than what you've lost and be able to take advantage of the gains that are available. The next 5 callers, 800-725-7616. We'll be right back after this.
I'm David Scranton, founder of the Retirement Income Store. If you're in or near retirement, are you certain you have the right retirement plan in place? Do you want to help ensure your nest egg will last you all throughout retirement? Take our retirement review quiz and find out in 5 minutes or less if you're doing everything you can to achieve a more successful retirement.
Visit us online at agemy.com. That's AGEMY.com. Welcome back to Financial Strategies with Andrew Agemy in Connecticut and Daniel Agemy in Colorado.
So, Daniel, it's important to know history, because if you don't know history, you're doomed to repeat it, right? And so let's talk about history for a minute. In 2007, November 2007, the Dow was at 14,200. Well, from November of 2007 through September of 2008, the market dropped. It dropped significantly, but it went down slowly over that 11-month period. And it went from 14,200 to 9,700, about 3,500 points. In the next 3 months, from September to December, the market dropped 3,000 points. Lesser points, but it was what was egregious to people. It was what people made people hit the panic button when it dropped that last bit, because it was like going from the frying pan into the fire for people, and that's what hurt the most. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Today we're talking about, is it a good idea to do a Roth conversion while markets are down? And where are you going with that story, AAA?
Well,
Where are you
well,
going with that story?
Well, the idea here is that the market has come down 25% right now. It's been about 10 months, and I don't see anything getting better. I see that it could be another time like 2008 could be right in front of us. And that's bad news for people who are invested in the market, but people who are invested in things, a strategy that is going to be able to pay them interest and dividends, that is not a bad time, because they're still going to be making money over that period of time. And this is a great time to change strategies from a growth market approach strategy into a dividend income paying strategy that they can actually be assured of getting growth. It's a great time to take advantage of that. People have not yet hit the panic button because they're used to the market going up so much. But in 2008, they did hit the panic button. And when you hit the panic button, it's too late. So that's where I'm going with it. I'm trying to help people to understand what they don't know, so that they don't have to suffer what other people will suffer.
Two quotes, two directions come to mind when you're talking about that. One, I guess I go with first, which was, people will say to you, well, Andrew, banks don't look like they did in 2008. We're not going to have a 2008. And I guess Mark Twain is, nobody really knows if he said it, but Mark Twain is credited for saying, history doesn't repeat itself, but it rhymes. And so you're not saying there's been another banking crisis, another housing crisis,
No.
because it's not going to be the same thing. It's not going to be another tech
Right.
bubble crash.
Right.
It's these are the things. It might be the Jay Powell crash, right? Who knows? Like,
Right.
no one knows. And you're just saying to prepare, right? And
Right.
that's where we go into this other one. Who was it? Louis Pasteur said, fortune favors the prepared mind.
Right.
So are you prepared? And are you prepared mentally? Is your portfolio prepared to
Right.
take advantage of these kinds of things? And if that is doing a Roth conversion so that you're able to get the gains in a tax-free basis, if that's just being prepared for a Roth conversion, if that's switching models, right?
Right.
Asking yourself, why am I in this aggressive model? Or am I in an aggressive model when I don't want to be, right?
Right. If you lost money, you're in an aggressive model.
Because I think your story is saying things go from okay to really bad or really quick. And if you're not prepared, that's where you get into trouble, because people don't make good decisions when, things are flying at them, when they're in a lot of pain.
Right.
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 And that's why when we look at JP Morgan's chart of how investments have done over the past 20 years,
Yeah.
and you see the average investor is somewhere between 2 and 3%, and the S&P is somewhere at 7.5%. It's because when everything's going crazy and you're in a lot of pain, people tend to hit the panic button,
Right.
which doesn't allow them to make smart decisions. And what we've been talking about is making the decision before you ready to hit the
Right.
panic button, making the decision. I'm going to stick through this. I like this hope model. Over time, markets go up, and I'm okay to
Right.
wait, 5 years, 10 years, 15 years for my portfolio to come back.
Right.
Or I'd like to go into one of these other models, a lateral move, where I can get set up for um, a little bit more confidence, a little bit more structure, a little bit more of a robust portfolio. Because if you go to the stock market income
Right.
model, then at least your dividends are coming in and reinvesting. So when markets come back, whenever that may be, you're not
Right.
back to even, you're far ahead, right?
Yeah. Nice, nice. So, going along with that, we have a paper we like to put in your hand to help you understand what Daniel's just saying there in regard to that, called Investing for Income in the Stock Market. You're listening to Financial Strategies with Andrew and Daniel Agemy. This father-son team's trying to help people to be able to know what they don't know and educate you to be able to make smart decisions. So we got this paper, Investing for Income in the Stock Market, so that you too can read through and have a clue as to be able to how to invest and make money, even though the stock market's going down. And we'd love to put that in your hand. Call us at 800-725-7616 for your free copy. 800-725-7616. Ask for it, but income in the stock market. Daniel, as we, have just a few minutes left into the show today, it's going fast and having a good time talking about this and trusting that people are being educated. Some of the things that people need to know is, the customization of a portfolio. So many times people are buying mutual funds or buying them from mutual fund salesmen. They're paying somebody to, I don't know anybody that would pay somebody to help them find a mechanic to work on their car, but that's what people are doing with their investments by having mutual fund salesmen, right? That have these portfolios that are just, not customized at all. All are these the kind of people that can actually help our listening audience to do what we're talking about here?
Well, I think the people listening really need to ask themselves, do are they happy? Are they satisfied with the way that their portfolios have done, this year? Is that acceptable?
Yeah,
Is
good
is
point.
cutting back on your spending, is that acceptable? And then are you are ideas being brought to you of how you can take advantage of these situations, or you can do some of these strategies where you're switching from um, this taxable model
Yeah,
to a tax-free model, right?
right.
And just some self-reflection, because it's a really good time to look at both the ability to switch models to a more certain, right, a more certain income, a more certain outcome, a more robust portfolio, and to be able to take advantage of the situation that you're in by not having to pay as much taxes at the same time.
Yeah. Yeah. Somebody that's kind of understands the bigger picture and and specializes in that, right? Somebody that is not just working with 20-year-olds and 30-year-olds, 40-year-olds, 50-year-olds, 60-year-olds and doing all the same stuff and can't look at the tax thing because their organizations tell them you're not tax professionals, you can't do that. But somebody that can look at that does taxes, that does investments, that understands the bigger picture, working with people specifically only, 50-year-olds, 60-year-olds, 70-year-olds, 80-year-olds, 90-year-olds, people in or close to retirement that specialize that, just like, a pediatrician specializes in children, and then as opposed to an adult doctor, somebody that specializes in retirement income, because they're a clearinghouse, right? They do this every day so that they understand what's happening out there and understand about these bump into brackets, understanding about the extra tax on Medicare that can come about, instead of being blindsided by it and the other things that retirees can face. Um, uh,
We
you
talked
know,
about that last week, being on top of the mountain, right? And having somebody who's been there before. And that is one of the most important things, because we can't say, to answer the question, should you do a Roth conversion
that's
right now?
right.
We can't
That's right.
say if you should or not, because each person's unique. Now, in
Mm-hmm.
general, it makes a lot of sense for a lot of people, but it hurts people too. And some people don't need to pay the taxes. You
Right.
don't need to do that. So it really is unique for you. And then like, you got to be careful what you convert, because just because you convert it doesn't mean it's going to benefit you, right?
That's right.
And so I hope, we got stuck in the weeds a couple of times, but I hope that this has been able to help people through that. So I think what we're saying here is you want somebody who's been there before, who understands that, who's helped hundreds of people be able to take advantage of these types of situations. Your portfolio is down.
Yeah.
That's not good. But what can you do to take advantage of that situation?
Right.
That's what you need, somebody who understands the intricacies, somebody that can work with you. If that's a tax professional that really gets it, if that's an investment advisor, if that's you going to some training, right? Going and taking some classes, understanding this fully, but getting the help, getting the education, because this hour podcast that we're doing, we're not able to understand each person individually. And maybe we should, because we've seen such, like I call it the wall of shame, since we've seen so much, maybe we should offer people, we could take a look at their portfolios and tell them if we see some cancer in there, because I really do feel bad for people that have been coming in with this stuff. They have no idea the growthy, right? I'm doing air quotes, the growthy stuff that they had in there. They just it's not profitable, and it's down 80% in their portfolio, and they thought they were moderate. Like that kind of stuff, unless you asked for that, unless you wanted to be that aggressive, is not appropriate for someone who's in or close to retirement.
Yeah, exactly. Well, that's good, Dan. You know what it comes to my mind is, we did a Roth IRA webinar, and on that we offer people a $1,200 Roth analysis for free. So if you're listening to this show and you would like us to analyze your assets to see if they work for Roth, if a Roth conversion will work for you, or make sure that tell you if we see cancer in your portfolio, you're welcome to call us and ask for the Roth analysis. Okay. 800-725-7616. Ask for the Roth analysis, or this book, Financial Insanity by David Scran. But either for free, we'll give you the complimentary Roth analysis, checking for the cancer in your portfolio, as well as if the Roth conversion will work for you, or you can have the book, Ask for by name, Stop Insanity. 800-725-7616. Thanks for listening to the show today. We'll look forward to talking with you again. You too can have a stress-free retirement.